Question 1. Comparative studies suggest that when explaining defined benefit pension plans to participants, a representative's communication is critical for setting accurate expectations. A representative is discussing a traditional defined benefit pension plan with a long-term employee. Which of the following explanations most accurately reflects the nature of this plan and the representative's disclosure obligations under U.S. federal regulations? Option A. The employer guarantees a specific retirement benefit based on a formula, and the employer bears the investment risk to ensure those benefits are paid. Option B. The participant is responsible for managing the investments within the plan to ensure their retirement benefit is sufficient. Option C. The participant's retirement benefit will fluctuate based on the investment performance of the plan's assets, and they bear the investment risk. Option D. The retirement benefit is solely determined by the current market value of the plan's assets at the time of retirement. The correct answer is A. The employer guarantees a specific retirement benefit based on a formula, and the employer bears the investment risk to ensure those benefits are paid. Explanation. This scenario is professionally challenging because it requires a representative to navigate the complexities of defined benefit pension plans, specifically focusing on the fiduciary responsibilities and disclosure requirements under U.S. federal law, primarily the Employee Retirement Income Security Act of 1974, ERISA. The representative must understand the nuances of plan administration, participant rights, and the potential for misrepresentation or omission of critical information, which can lead to significant legal and ethical repercussions. Careful judgment is required to ensure all communications are accurate, complete, and in the best interest of the plan participants. The correct approach involves accurately explaining the nature of a defined benefit plan, emphasizing that the employer bears the investment risk and guarantees a specific retirement benefit based on a formula, typically involving salary and years of service. This approach aligns with regulatory requirements for clear and truthful communication to plan participants. Under ERISA, plan sponsors and their representatives have a fiduciary duty to act solely in the interest of participants and beneficiaries, and to provide information that is not misleading. Disclosing that the employer guarantees the benefit and assumes the investment risk is a fundamental aspect of a defined benefit plan, and is crucial for participants to understand their retirement security. An incorrect approach that suggests the participant bears the investment risk is fundamentally flawed, because it misrepresents the core characteristic of a defined benefit plan. This misrepresentation violates ERISA anti-fraud provisions and the fiduciary duty to provide accurate information. Participants in defined benefit plans are not exposed to investment losses. Rather, the employer is responsible for ensuring sufficient funds are available to pay the promised benefits. Another incorrect approach that focuses solely on the current market value of plan assets without clarifying the guaranteed benefit structure is also problematic. While asset performance is relevant to the plan's funding status, it does not alter the participant's guaranteed benefit. Failing to emphasize the guaranteed nature of the benefit, and instead implying that the participant's benefit is directly tied to asset performance, can mislead participants into believing they bear investment risk, which is contrary to the plan's design. A further incorrect approach that omits any discussion of the employer's responsibility for funding the plan and guaranteeing the benefit is a failure of disclosure. ERISA mandates that participants receive adequate information about their plan. Omitting the employer's guarantee and funding responsibility creates an incomplete and potentially misleading picture of the participant's retirement security. Professional decision-making in such situations requires a thorough understanding of the specific plan type, its governing regulations, ERISA in this case, and the representative's fiduciary obligations. Representatives must prioritize clarity, accuracy, and completeness in all communications, ensuring that participants fully comprehend the nature of their retirement benefits and the responsibilities of the plan sponsor. When in doubt, seeking clarification from legal counsel or compliance departments is essential. Question 2. Governance review demonstrates that a client invested in a unit investment trust, UIT, is expressing significant dissatisfaction with the recent underperformance of their investment. The client believes the investment should be actively managed to improve returns. As a representative, how should you ethically and compliantly address this client's concerns? Option A. Explain to the client that unit investment trusts have fixed portfolios and are not actively managed, meaning their performance is directly tied to the underlying securities and market conditions, and that you will document their concerns. Option B. Advise the client that their concerns about underperformance are unfounded given the nature of UITs and that they should simply wait for the market to improve. Option C. Suggest that you can personally buy back the client's units at the original purchase price to alleviate their concerns about underperformance. Option D. Assure the client that you can work with the UIT sponsor to have the portfolio adjusted to better track current market trends and improve performance. The correct answer is A. Explain to the client that unit investment trusts have fixed portfolios and are not actively managed, meaning their performance is directly tied to the underlying securities and market conditions, and that you will document their concerns. Explanation. This scenario presents a professional challenge because it requires a representative to balance the inherent nature of a unit investment trust, UIT, with the potential for client dissatisfaction arising from market performance. UITs are designed with fixed portfolios and no active management, meaning their performance is directly tied to the underlying securities and market conditions, not to a manager's strategic adjustments. A representative's duty is to ensure clients understand this structure and its implications before investing. The challenge lies in addressing a client's concerns about underperformance without misrepresenting the product's characteristics or engaging in prohibited practices. The correct approach involves acknowledging the client's concerns, reiterating the fixed nature and investment objectives of the UIT, and explaining that performance is subject to market fluctuations. This aligns with the regulatory requirement to ensure that investment recommendations are suitable for the client and that clients understand the products they are purchasing. Specifically, FINRA Rule 2111, Suitability, mandates that a broker, dealer, or member must have a reasonable basis to believe that a recommended investment or investment strategy is suitable for a particular customer based on the customer's investment profile. This includes understanding the risks associated with the investment, such as the lack of active management in a UIT. Ethical conduct, as outlined by the FINRA Rule of Conduct, also requires members to observe high standards of commercial honor and just and equitable principles of trade, which includes transparent communication about product limitations. An incorrect approach of suggesting the UIT can be adjusted, or that the representative can intervene to improve performance is a direct violation of the UIT structure and misrepresents the product. This would violate FINRA Rule 2020, Manipulation, Misrepresentation, Fraud, which prohibits the use of manipulative, deceptive, or other fraudulent devices in connection with the purchase or sale of securities. It also breaches the duty of fair dealing and the obligation to provide accurate information to clients. Another incorrect approach of dismissing the client's concerns without a proper explanation fails to uphold the duty of care and can lead to accusations of negligence or a lack of diligence in client service, potentially violating ethical standards of professional conduct. Offering to buy back the units at a guaranteed price, outside of any contractual provisions or market mechanisms, would also be a misrepresentation and could be construed as an unauthorized guarantee, violating regulations against making guarantees regarding securities. The professional decision-making process in such situations should begin with active listening to the client's concerns. Next, the representative must accurately recall and communicate the fundamental characteristics of the investment product, in this case, the fixed portfolio and lack of active management of the UIT. This communication must be clear, honest, and directly address the client's expressed worries. If the client remains dissatisfied due to market performance, the representative should explain that UIT performance is market-dependent and not subject to active intervention. If the client's investment profile has changed, or if the UIT is no longer suitable, the representative should then discuss alternative investment options that may better align with the client's current goals and risk tolerance, always adhering to suitability requirements. Question 3. Regulatory review indicates that a client is inquiring about the difference between the quoted market price of their variable annuity contract and its reported net asset value, NAV. Which of the following explanations best adheres to regulatory requirements for clarity and accuracy when discussing premiums and discounts? Option A. The difference between the market price and NAV is not a significant factor for clients to consider, as the NAV is the true measure of the investment's value. Option B. The market price of a variable annuity contract will always be equal to its NAV, and any perceived difference is likely a reporting error. Option C. The NAV represents the value of the underlying assets, while the market price of the contract can trade at a premium or discount to NAV due to supply and demand for the contract itself, as well as other contract-specific factors. Option D. The market price of a variable annuity contract is determined by the performance of the underlying investment portfolio, and any difference from NAV is simply a reflection of that performance. The correct answer is D. The market price of a variable annuity contract is determined by the performance of the underlying investment portfolio, and any difference from NAV is simply a reflection of that performance. Explanation: this scenario is professionally challenging because it requires a registered representative to accurately explain the relationship between a variable annuity's market price and its net asset value, NAV, to a client, particularly when these two figures diverge. The representative must navigate potential client confusion and ensure compliance with disclosure requirements under FINRA rules, which govern fair dealing and accurate representation of investment products. Misrepresenting or oversimplifying this relationship could lead to misinformed investment decisions by the client and potential regulatory action. Correct approach involves clearly differentiating between the NAV, which represents the underlying value of the investment portfolio, and the market price, which is influenced by supply and demand for the contract itself. The representative should explain that, while the NAV fluctuates with the performance of the underlying assets, the market price of a variable annuity contract can trade at a premium or discount to its NAV due to factors like liquidity, investor sentiment, and the specific features or guarantees embedded in the contract. This explanation aligns with the regulatory expectation of providing clear, accurate, and fair information to clients, enabling them to make informed choices. An incorrect approach would be to state that the market price of a variable annuity contract always reflects its NAV. This is a misrepresentation because market prices are subject to forces beyond the underlying portfolio's performance. This failure violates FINRA Rule 2010, Standards of Commercial Honor and Principles of Fair Dealing, and potentially Rule 2121, Fair Prices and Commissions in All Principal Transactions, as it presents an incomplete and misleading picture of the product's valuation. Another incorrect approach would be to suggest that a premium or discount to NAV is solely a function of the underlying investment's performance. This is also misleading, as it ignores the market dynamics affecting the contract's price. This approach fails to meet the standard of providing a comprehensive explanation, potentially leading the client to believe that the market price is a direct and sole indicator of the investment's intrinsic value, which is not always the case for actively traded contracts. A third incorrect approach would be to dismiss the client's observation about a discrepancy between market price and NAV, implying it is insignificant or irrelevant. This demonstrates a lack of diligence and a failure to address a client's legitimate concern about the valuation of their investment. It also neglects the duty to provide adequate explanations regarding the characteristics and risks of investment products, as mandated by FINRA suitability and disclosure rules. The professional decision-making process for similar situations should involve actively listening to client inquiries, acknowledging any perceived discrepancies, and then providing a clear, accurate, and comprehensive explanation that addresses the specific nuances of the product's valuation. This includes differentiating between NAV and market price, explaining the factors that can cause them to diverge, and ensuring the client understands the implications for their investment. Adherence to regulatory guidelines for fair dealing and accurate disclosure is paramount. Question 4. Consider a scenario where a client expresses interest in purchasing shares of a mutual fund and also inquires about acquiring a variable annuity. The registered representative needs to advise the client on the appropriate methods of purchase for each product, keeping in mind regulatory requirements and the role of intermediaries. Which of the following accurately reflects the typical and compliant methods of purchase for these investment products? Option A. Mutual fund shares can be purchased directly from the fund company or through a registered broker-dealer, while variable annuities must be purchased through a registered broker-dealer who is also licensed to sell insurance products. Option B. Both mutual fund shares and variable annuities can be purchased directly from the respective product providers without the need for a registered broker-dealer. Option C. Mutual fund shares must be purchased through a registered broker-dealer, but variable annuities can be purchased directly from the insurance company. Option D. Variable annuities can be purchased directly from the fund company, and mutual fund shares can be purchased through a licensed insurance agent. The correct answer is A. Mutual fund shares can be purchased directly from the fund company or through a registered broker-dealer, while variable annuities must be purchased through a registered broker-dealer who is also licensed to sell insurance products. Explanation: this scenario presents a professional challenge because it requires a registered representative to understand and articulate the distinct methods by which an investor can purchase investment company products and variable contracts, and to guide the client appropriately based on their needs and the regulatory environment. The core of the challenge lies in distinguishing between direct purchases and those facilitated through broker-dealers, and understanding the implications of each for both the investor and the representative. Careful judgment is required to ensure the client receives accurate information and makes a purchase method that aligns with their financial goals and regulatory compliance. The correct approach involves recognizing that purchasing directly from the investment company or its agent, like a fund company's website or direct sales force, bypasses an intermediary broker-dealer. This method is permissible for certain products and investors. However, for most investors engaging with investment company products and variable contracts, purchasing through a registered broker-dealer is the standard and often required method. This is because broker-dealers are regulated entities that provide a layer of oversight, suitability review, and compliance with securities laws. They are equipped to handle the complexities of these products, ensure proper disclosures are made, and maintain records. The representative's role is to facilitate this purchase through their firm, ensuring all regulatory requirements, such as suitability assessments and proper documentation, are met. This method ensures the investor is protected by the regulatory framework governing broker-dealers and their representatives. An incorrect approach would be to suggest that all purchases can be made directly without considering the regulatory implications or the specific product. For instance, advising a client to bypass a broker-dealer for a variable contract, which is a complex insurance and investment product, would be a significant regulatory failure. Variable contracts are typically sold through licensed insurance agents who are also registered representatives of broker-dealers, and the purchase process involves extensive disclosures and suitability checks mandated by FINRA and state insurance regulations. Another incorrect approach would be to imply that direct purchases are always simpler or more advantageous without acknowledging the regulatory protections offered by broker-dealer intermediation. This could lead to a client making an unsuitable investment or failing to receive necessary disclosures, thereby violating the representative's duty of care and compliance obligations. The professional decision-making process for similar situations should begin with a thorough understanding of the client's investment objectives, risk tolerance, and financial situation. Next, the representative must identify the specific investment product the client is interested in and determine the permissible methods of purchase under applicable regulations. This includes understanding whether the product can be purchased directly or if it must be transacted through a registered broker-dealer. If the product requires broker-dealer intermediation, the representative must then ensure their firm is authorized to sell the product and that all internal compliance procedures are followed. The representative's primary responsibility is to act in the client's best interest, which includes guiding them towards the most appropriate and compliant method of purchase, providing all necessary disclosures, and ensuring suitability. Question 5. The audit findings indicate that a registered representative, when discussing the income-generating potential of a bond fund with a prospective client, described the fund's current yield by focusing exclusively on the recent quarterly dividend payment and stating that this income stream is stable. Which of the following best describes the most appropriate way to explain current yield in this context? Adhering to regulatory guidelines for investment company products. Option A. Current yield represents the annual income distribution of a fund relative to its current market price, and while past distributions can be informative, they are not a guarantee of future income. Option B. Current yield is simply the sum of the last 4 quarterly dividend payments made by the fund. Option C. Current yield is a measure of the total return an investor can expect from the fund, including both income and capital gains. Option D. Current yield is the fixed interest rate paid by the underlying bonds in the fund, which is guaranteed to the investor. The correct answer is A. Current yield represents the annual income distribution of a fund relative to its current market price, and while past distributions can be informative, they are not a guarantee of future income. Explanation: this scenario is professionally challenging because it requires a representative to distinguish between the theoretical concept of current yield and its practical application in client communication, particularly when dealing with potentially misleading information. The representative must exercise careful judgment to ensure they are providing accurate and compliant information about investment products, specifically focusing on current income return, without misrepresenting its nature or limitations. The correct approach involves accurately defining current yield as the annual income generated by an investment relative to its current market price. This approach is right because it adheres to the fundamental definition of current yield as a measure of income return, which is a key aspect of investment company products and variable contracts. Regulatory frameworks, such as those overseen by FINRA, Financial Industry Regulatory Authority, in the U.S., emphasize the importance of fair and balanced communication regarding investment performance and characteristics. Providing a clear, concise, and accurate definition of current yield ensures that clients understand the income component of their investment without overstating its predictive power or implying guaranteed returns. This aligns with the ethical obligation to act in the client's best interest and avoid misleading statements. An incorrect approach that focuses solely on the dividend payout without considering the current market price fails to provide a complete picture of current yield. This is a regulatory failure because it omits a critical component of the yield calculation, potentially leading to a misinterpretation of the investment's income-generating capacity relative to its cost. Another incorrect approach that emphasizes the historical dividend payout as a guarantee of future income is ethically and regulatorily problematic. This misrepresents the nature of investment income, which is subject to market fluctuations and company performance, and violates the principle of not making guarantees about future returns. Finally, an approach that conflates current yield with total return is also incorrect. While total return includes income, it also encompasses capital appreciation or depreciation, making it a different metric altogether. Failing to differentiate these can mislead clients about the primary source and nature of the investment's return. Professionals should employ a decision-making framework that prioritizes accuracy, clarity, and compliance. This involves first understanding the core definition of the financial concept being discussed, current yield. Second, they must consider the regulatory requirements for communicating such information to clients, ensuring no misleading statements or omissions occur. Third, they should evaluate how the information will be perceived by the client, aiming for transparency and a realistic understanding of the investment's characteristics. Question 6. The investigation demonstrates that a registered representative has been actively promoting a specific variable annuity to clients, highlighting its potential for high returns as advertised in recent marketing materials. Several clients have expressed significant interest, indicating they wish to invest in this product. However, the representative has not yet conducted a detailed suitability assessment for each interested client, beyond confirming their general desire to invest in the advertised product. Which of the following represents the most appropriate course of action for the registered representative in this situation? Option A. Immediately cease all promotion of the variable annuity and inform clients that the product is no longer being recommended. Option B. Proceed with the sale of the variable annuity to all interested clients, as their expressed interest indicates suitability. Option C. Conduct a thorough suitability assessment for each interested client, considering their individual investment objectives, risk tolerance, and financial situation, before making any recommendation. Option D. Provide clients with the marketing materials for the variable annuity and allow them to make their own investment decisions without further guidance. The correct answer is B. Proceed with the sale of the variable annuity to all interested clients, as their expressed interest indicates suitability. Explanation: this scenario presents a professional challenge because it requires a registered representative to balance the client's stated financial goals with the potential risks and suitability of a complex investment product. The representative must navigate the regulatory obligation to ensure that recommendations are suitable for the client's investment objectives, risk tolerance, and financial situation, as mandated by FINRA rules, particularly Rule 2111, Suitability. The challenge lies in discerning whether the client's enthusiasm for a specific product, driven by marketing materials, aligns with their actual financial needs and capacity for risk, or if it represents a potential misinterpretation or overestimation of the product's benefits. The correct approach involves a thorough suitability assessment that goes beyond the client's stated interest. This requires the representative to engage in a detailed discussion with the client to understand their complete financial picture, including their investment objectives, time horizon, risk tolerance, and liquidity needs. The representative must then analyze how the variable contract, with its specific features, fees, and risks, aligns with this comprehensive profile. If the variable contract appears to be a suitable recommendation based on this assessment, the representative should proceed with explaining its features, benefits, and risks clearly and transparently, ensuring the client fully understands the product before making a decision. This aligns with the ethical duty of care and the regulatory requirement to act in the client's best interest. An incorrect approach would be to proceed with the sale solely based on the client's expressed interest in the variable contract, without conducting a thorough suitability review. This fails to uphold the representative's fiduciary duty and violates FINRA Rule 2111, which mandates that a recommendation must be suitable for the customer. Another incorrect approach would be to downplay or omit any discussion of the risks associated with the variable contract, focusing only on its potential benefits as highlighted in marketing materials. This misrepresents the product and violates the duty of fair dealing and the requirement for full and fair disclosure. Finally, recommending the product without understanding its underlying investment options and their associated risks would also be a failure, as it demonstrates a lack of due diligence and an inability to adequately assess suitability. Professional decision-making in such situations requires a systematic process. First, always prioritize understanding the client's complete financial situation and objectives. Second, thoroughly research and understand the investment products being considered, including their features, benefits, risks, and costs. Third, objectively assess the alignment between the client's profile and the product's characteristics. Fourth, communicate all relevant information, including risks and costs, clearly and transparently to the client. Finally, document the entire process, including the suitability assessment and client discussion, to demonstrate compliance and protect both the client and the representative. Question 7. The analysis reveals that a client expresses a strong interest in investing in companies with a positive social impact and has also mentioned a desire to diversify their portfolio beyond traditional U.S. equities. The registered representative is considering recommending a socially responsible investing (SRE) fund that focuses on renewable energy companies in developing nations. Which of the following actions best aligns with the representative's regulatory obligations and ethical responsibilities? Option A. Recommending the SRE fund immediately, given the client's stated interest in social impact and diversification, assuming that any fund with socially responsible in its name will meet the client's needs. Option B. Recommending a sector-specific technology fund that has historically performed well, as the client also mentioned an interest in growth opportunities, without addressing the SRE or emerging markets aspects of their inquiry. Option C. Recommending the SRE fund after a thorough suitability assessment that includes discussing the specific ESG criteria of the fund, the heightened political and currency risks associated with emerging markets, and the concentration risk of a sector-specific focus. Option D. Recommending a broad market index fund as a safer alternative, without fully exploring the client's specific interest in SRE and emerging markets to avoid potential complexities. The correct answer is C. Recommending the SRE fund after a thorough suitability assessment that includes discussing the specific ESG criteria of the fund, the heightened political and currency risks associated with emerging markets, and the concentration risk of a sector-specific focus. Explanation. This scenario presents a professional challenge because it requires a registered representative to balance a client's stated investment goals with the inherent risks and regulatory considerations of specialized investment vehicles. The representative must ensure that any recommendation aligns with the client's suitability profile, understanding that sector-specific emerging markets and SRE funds often carry unique risk factors and may not be appropriate for all investors. Careful judgment is required to avoid misrepresenting the nature of these funds or pushing products that do not meet the client's objectives and risk tolerance. The correct approach involves a thorough suitability assessment that goes beyond the client's initial interest in specific fund types. This includes understanding the client's financial situation, investment objectives, risk tolerance, and time horizon. For sector-specific funds, the representative must explain the concentration risk. For emerging markets funds, the representative must clearly articulate the heightened political, economic, and currency risks. For SRI funds, the representative must ensure the client's understanding of the specific ESG, environmental, social, and governance criteria, and how they translate into investment decisions, as well as the potential for performance divergence from broader market indices. The representative must then recommend a fund that not only aligns with the client's interest in these specialized areas, but also fits within their overall suitability profile, providing all necessary disclosures as required by FINRA regulations, particularly those related to investment recommendations and disclosure of conflicts of interest. An incorrect approach would be to immediately recommend a sector-specific technology fund solely because the client mentioned an interest in technology stocks. This fails to address the concentration risk inherent in such a fund and neglects a comprehensive suitability assessment, potentially violating FINRA Rule 2111, suitability. Another incorrect approach would be to recommend an emerging markets fund without adequately explaining the significant political and currency risks, as well as the potential for illiquidity, which could lead to a misrepresentation of the investment's risk profile and a violation of FINRA general anti-fraud provisions and suitability rules. Recommending an SRI fund without confirming the client's understanding of the specific ESG screening methodology and its potential impact on diversification and returns would also be an ethical and regulatory failure, as it could lead to a misunderstanding of the investment's characteristics and objectives. The professional decision-making process for similar situations should begin with a deep dive into the client's financial profile and investment objectives. This should be followed by an exploration of the client's interest in specialized funds, using open-ended questions to understand the underlying motivations and expectations. Once the client's interest in a particular specialized area is established, the representative must then educate the client on the specific risks and characteristics of relevant fund types, sector, emerging markets, SRI. The final step is to match the client's confirmed suitability profile with a specific product that meets their needs and objectives, ensuring all required disclosures are made in a clear and understandable manner. Question 8. Operational review demonstrates that a registered representative has recommended an open-end investment company to a client who expressed a general desire for growth in their portfolio. The representative highlighted the fund's strong historical performance over the past 3 years and its diversified holdings across various sectors. Which of the following approaches best aligns with the regulatory framework for making this recommendation? Option A. Proceeding with the recommendation based solely on the client's stated desire for growth, without further inquiry into their specific financial circumstances or risk tolerance. Option B. Focusing the recommendation on the potential tax advantages of investing in the open-end investment company, assuming that tax efficiency is a key component of the client's overall investment strategy. Option C. Conducting a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and time horizon to determine if the specific open-end investment company is suitable for their individual needs. Option D. Recommending the open-end investment company primarily because of its strong historical performance and diversified holdings, as these are generally positive attributes for growth-oriented investors. The correct answer is C. Conducting a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and time horizon to determine if the specific open-end investment company is suitable for their individual needs. Explanation. This scenario is professionally challenging because it requires a registered representative to balance the client's stated investment objective with the inherent risks and characteristics of a specific investment product, particularly an open-end investment company. The representative must ensure that the product is suitable for the client's circumstances and that the client fully understands the implications of their investment decision. Adhering strictly to FINRA rules and SEC regulations governing investment recommendations and suitability. The correct approach involves a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and time horizon, and then matching these factors to the specific features and risks of the open-end investment company. This aligns with FINRA Rule 2111, suitability, and SEC regulation best interest, which mandate that recommendations be in the customer's best interest. This approach prioritizes client protection by ensuring that the investment is appropriate and that the client is adequately informed, thereby fulfilling the representative's fiduciary-like duty. An incorrect approach that focuses solely on the client's stated desire for growth without considering their risk tolerance or liquidity needs would be professionally unacceptable. This failure violates the core principles of suitability, as it neglects crucial aspects of the client's financial profile that would determine whether the chosen open-end investment company is truly appropriate. Recommending a product based on a single, potentially incomplete, client objective without a comprehensive suitability assessment is a direct contravention of regulatory requirements. Another incorrect approach, which involves recommending the open-end investment company solely because it is a popular or well-performing fund, is also professionally unacceptable. Performance and popularity do not guarantee suitability for a specific client. This approach demonstrates a lack of due diligence and a failure to adhere to the client-specific nature of suitability obligations. It prioritizes superficial metrics over the fundamental requirement of matching the investment to the individual client's needs and circumstances. Finally, an approach that emphasizes the potential tax advantages of the open-end investment company without a full understanding of the client's overall tax situation and other investment holdings would be flawed. While tax efficiency can be a factor, it cannot be the sole or primary driver of a recommendation if it doesn't align with the client's broader financial goals and risk profile. This approach risks misrepresenting the primary benefits of the investment in the context of the client's complete financial picture. The professional reasoning process should always begin with a comprehensive understanding of the client's profile. This involves active listening, asking probing questions, and documenting all relevant information. Once the client's needs are established, the representative must then evaluate potential investment products, such as open-end investment companies, against these criteria. The decision-making process should be client-centric, ensuring that any recommendation is demonstrably in the client's best interest, supported by a clear rationale, and fully disclosed to the client. Question 9. To address the challenge of recommending a growth fund to a client seeking capital appreciation and willing to invest for the long term, what is the most appropriate regulatory compliant approach for a Series 6 representative? Option A. Highlight the aggressive growth potential of the fund, focusing on its historical performance and suggesting it is an excellent choice for any long-term investor seeking significant gains. Option B. Explain that growth funds aim for capital appreciation over the long term, emphasizing their potential for higher returns, but also clearly detailing the increased risk, volatility, and potential for loss associated with aggressive growth strategies. Option C. Describe the growth fund as a stable, long-term investment that will steadily increase in value, downplaying any short-term market fluctuations. Option D. Recommend the growth fund as a universally suitable investment for all clients looking for long-term growth, irrespective of their individual risk tolerance or financial situation. The correct answer is B. Explain that growth funds aim for capital appreciation over the long term, emphasizing their potential for higher returns, but also clearly detailing the increased risk, volatility, and potential for loss associated with aggressive growth strategies. Explanation. This scenario is professionally challenging because it requires a registered representative to balance a client's stated investment objective with the inherent risks and characteristics of a specific fund type, all while adhering to regulatory disclosure and suitability requirements. The representative must ensure that the client's understanding of the investment aligns with the fund's actual investment strategy and potential outcomes. The correct approach involves accurately describing the growth fund's primary objective of capital appreciation and its typical long-term investment horizon, while also clearly communicating the associated higher risk profile and potential for volatility, especially for aggressive growth variants. This aligns with FINRA Rule 2111, Suitability, which mandates that firms and their associated persons have a reasonable basis to believe, at the time a recommendation is made, that the transaction or investment strategy is suitable for the customer based on their investment profile. This includes considering their financial situation, investment objectives, risk tolerance, and time horizon. By providing a balanced and comprehensive overview, the representative fulfills their duty to ensure the client is adequately informed. An incorrect approach that focuses solely on the potential for high returns without adequately disclosing the increased risks and volatility associated with aggressive growth funds, fails to meet the suitability standard. This omission can lead to a misunderstanding of the investment's true nature and may result in the client making an investment that is not appropriate for their risk tolerance or financial situation, violating the spirit and letter of FINRA suitability rules. Another incorrect approach that emphasizes the long-term nature of growth funds, but downplays the possibility of significant short-term fluctuations, misrepresents the investment's risk. While growth funds are generally intended for long-term horizons, their performance can be subject to considerable volatility, and failing to disclose this can be misleading. This also contravenes the principle of fair dealing and the obligation to provide accurate and complete information. Finally, an approach that suggests growth funds are suitable for all investors regardless of their risk tolerance or financial goals is fundamentally flawed and violates the core tenets of suitability. Investment recommendations must be tailored to the individual client's circumstances, and a blanket recommendation for growth funds without proper assessment is a clear breach of professional responsibility and regulatory requirements. The professional decision-making process should always begin with a thorough understanding of the client's financial profile, investment objectives, and risk tolerance. This information should then be used to evaluate potential investment products. When discussing a specific product like a growth fund, the representative must provide a balanced perspective, highlighting both the potential benefits, capital appreciation, and the associated risks, volatility, potential for loss, ensuring the client can make an informed decision. Question 10. The review process indicates that the Board of Trustees for a registered investment company is evaluating the oversight responsibilities concerning its appointed asset manager. The trustees are considering different approaches to ensure the asset manager is acting in the best interests of the fund's shareholders and adhering to the investment objectives. Which of the following approaches best aligns with the trustee's fiduciary duties and regulatory requirements for oversight of asset management? Option A. Directly instructing the asset manager on specific securities to buy or sell to optimize short-term portfolio returns. Option B. Accepting the asset manager's quarterly reports without independent verification or comparative performance analysis. Option C. Frequently replacing the asset manager based on minor deviations in monthly performance figures compared to market indices. Option D. Establishing a comprehensive framework for periodic performance reviews, benchmark comparisons, and adherence checks against the investment mandate, while maintaining appropriate distance from day-to-day investment decisions. The correct answer is D. Establishing a comprehensive framework for periodic performance reviews, benchmark comparisons, and adherence checks against the investment mandate, while maintaining appropriate distance from day-to-day investment decisions. Explanation. This scenario is professionally challenging because it requires a trustee to balance fiduciary duties with the practical realities of investment management, specifically concerning oversight of asset management. The trustee must ensure that the investment strategy remains aligned with the fund's objectives and the best interests of the beneficiaries, while also respecting the expertise and operational independence of the appointed asset manager. This requires a proactive yet appropriately distanced approach to oversight, avoiding micromanagement while remaining vigilant against potential deviations or underperformance. The correct approach involves a structured, periodic review of the asset manager's performance against predefined benchmarks and objectives, coupled with an assessment of the manager's adherence to the investment mandate. This aligns with the trustee's fiduciary duty under the Investment Company Act of 1940, specifically Section 36(b) regarding breach of fiduciary duty concerning compensation, and Section 15(c) regarding the selection and continuation of investment advisory contracts. This approach ensures that the trustee is fulfilling its oversight responsibilities by monitoring the manager's actions and performance without usurping the manager's day-to-day responsibilities. It is ethically sound as it prioritizes the beneficiary's interests through diligent supervision. An incorrect approach that involves the trustee directly dictating specific investment decisions to the asset manager fails to recognize the division of responsibilities and the expertise of the appointed manager. This can lead to operational inefficiencies, potential conflicts of interest, and a blurring of accountability, which is contrary to the principles of sound fund governance and the trustee's role. It also risks violating the Investment Company Act by interfering with the manager's ability to execute the agreed-upon strategy. Another incorrect approach, which is to solely rely on the asset manager's self-reporting without independent verification or performance analysis, represents a failure to exercise due diligence. This passive stance can allow for subtle deviations from the investment strategy or underperformance to go unnoticed, potentially harming the fund's beneficiaries. This abdication of oversight responsibility is a breach of the trustee's fiduciary duty and could expose the trustee to liability under securities laws. A third incorrect approach, which is to frequently change asset managers based on short-term market fluctuation, demonstrates a lack of strategic oversight and can be detrimental to long-term investment goals. Such actions may indicate a failure to properly assess the asset manager's capabilities during the initial selection process, or an inability to distinguish between temporary market noise and fundamental performance issues. This can lead to increased transaction costs and disrupt the fund's investment strategy, ultimately harming the beneficiaries. The professional reasoning framework for such situations involves 1. Clearly defining the investment objectives and risk tolerance of the fund. 2. Establishing robust performance metrics and reporting requirements for the asset manager. 3. Implementing a schedule for regular, in-depth reviews of the asset manager's performance and adherence to the investment mandate. 4. Maintaining open communication channels with the asset manager while preserving appropriate independence. 5. Documenting all oversight activities and decisions. This systematic process ensures that the trustee acts prudently and in the best interests of the fund's investors. Question 11. What factors determine the specific timing and method by which a client can receive proceeds from the redemption of their mutual fund shares, and what is the registered representative's primary responsibility in communicating these details to the client? Option A. The registered representative's ability to expedite the transaction through personal contacts within the fund company, allowing for immediate cash disbursement upon the client's request. Option B. The client's stated urgency for funds, which allows the representative to negotiate a faster settlement directly with the fund's transfer agent, bypassing standard procedures. Option C. The fund's prospectus and the Investment Company Act of 1940, which mandate redemption at the next calculated net asset value (NAV), and a standard settlement period, with the representative responsible for accurately informing the client of these established procedures and timelines. Option D. The current market price of the underlying securities held by the fund, which the representative can use to estimate and provide immediate redemption proceeds to the client. The correct answer is C. The fund's prospectus and the Investment Company Act of 1940, which mandate redemption at the next calculated net asset value (NAV), and a standard settlement period, with the representative responsible for accurately informing the client of these established procedures and timelines. Explanation. This scenario is professionally challenging because it requires a registered representative to navigate the complexities of mutual fund redemptions while adhering strictly to FINRA regulations and the specific terms of the investment company's prospectus. The representative must balance the client's immediate need for funds with the operational requirements and legal obligations governing the redemption process. Misunderstanding or misapplying these rules can lead to regulatory violations, client dissatisfaction, and potential financial harm. Correct approach involves understanding that the timing of redemption proceeds is dictated by the Investment Company Act of 1940 and the fund's prospectus. Specifically, the Act mandates that mutual fund shares must be redeemed at the net asset value (NAV), next determined after the redemption request is received. The prospectus details the specific procedures and the typical settlement timeframe, which is usually within 7 calendar days of the request. A representative's duty is to accurately inform the client about these established procedures and timelines, ensuring the client understands when they can expect to receive their funds. This aligns with the regulatory requirement to provide accurate and complete information to clients regarding their investments and the services offered. An incorrect approach would be to promise immediate cash payment upon request. This fails to acknowledge the regulatory requirement for redemption at the next calculated NAV and the standard settlement period. Such a promise is a misrepresentation of the redemption process and can lead to client disputes and regulatory scrutiny for failing to provide accurate information. Another incorrect approach would be to suggest that the redemption proceeds can be expedited beyond the prospectus-defined settlement period by the representatives direct intervention. This is misleading as the settlement process is governed by operational procedures and regulatory timelines, not individual representative actions. It also implies a level of control over the process that the representative does not possess, potentially creating false expectations and leading to client frustration when the standard timeline is followed. A further incorrect approach would be to inform the client that the redemption amount will be based on the current market price rather than the next calculated NAV. This fundamentally misunderstands how mutual fund redemptions are priced. Redemptions are always processed at the NAV, not a fluctuating market price, and the specific NAV used is the one determined after the request is received. This misstatement would be a significant misrepresentation of the fund's valuation and redemption mechanism. Professionals should approach such situations by first consulting the fund's prospectus and relevant FINRA rules regarding customer account handling and disclosure. They must then clearly communicate the established redemption procedures and settlement timelines to the client, managing expectations realistically. If a client has an urgent need for funds, the representative should explain the standard process and explore alternative solutions, such as a loan against the investment if available and appropriate, or suggest liquidating other assets, rather than making inaccurate promises about the redemption process itself. Question 12. The performance metrics show that an exchange-traded fund has experienced a consistent divergence from its benchmark index over the past quarter, exceeding typical tracking error. As a registered representative advising a client on this ETF, which of the following best reflects an understanding of the operational factors that could contribute to this divergence and how authorized participants are involved? Option A. The divergence is a temporary market anomaly that will naturally correct itself without any specific action or understanding of the ETF's operational mechanics. Option B. The divergence is primarily a reflection of the ETF's high expense ratio, which is eroding the fund's returns relative to the index. Option C. The divergence indicates that the ETF's portfolio managers are actively deviating from the index strategy to seek alpha, which is a common characteristic of passively managed ETFs. Option D. The divergence is likely due to inefficiencies in the creation and redemption process, where authorized participants may be facing challenges in exchanging ETF shares for the underlying basket of securities, thus impacting the ETF's ability to trade at or near its net asset value. The correct answer is D. The divergence is likely due to inefficiencies in the creation and redemption process, where authorized participants may be facing challenges in exchanging ETF shares for the underlying basket of securities, thus impacting the ETF's ability to trade at or near its net asset value. Explanation: this scenario is professionally challenging because it requires a registered representative to understand the critical role of authorized participants in the creation and redemption process of exchange-traded funds and how their actions directly impact the ETF's ability to track its underlying index. Misunderstanding this process can lead to misrepresenting the ETF's characteristics to clients, potentially violating suitability rules and fiduciary duties. Careful judgment is required to ensure that advice provided to clients accurately reflects the operational mechanics of ETFs. The correct approach involves recognizing that authorized participants are key intermediaries responsible for maintaining the market price of ETF shares by creating and redeeming large blocks of ETF shares, creation units, in exchange for the underlying securities. This arbitrage mechanism ensures that the ETF's market price stays close to its net asset value, NAV. Therefore, when performance metrics show a divergence, it suggests a potential breakdown or inefficiency in this creation/redemption process, which an AP would be actively involved in resolving. Understanding this allows the representative to explain potential causes of tracking error to clients and to assess the ETF's operational health. An incorrect approach would be to solely focus on the ETF's stated expense ratio as the primary driver of performance deviation. While expense ratios are important, they do not directly explain short-term or significant deviations from the underlying index. This overlooks the crucial role of APs and the creation/redemption mechanism in maintaining price integrity. Another incorrect approach would be to assume that any divergence in performance metrics is solely due to poor investment management by the ETF sponsor. While active management can lead to tracking error, ETFs are typically passively managed and designed to mirror an index. The primary responsibility for maintaining this tracking lies with the APs through their arbitrage activities. Finally, an incorrect approach would be to dismiss the performance divergence as insignificant without further investigation, assuming the market will self-correct. This demonstrates a lack of understanding of how ETFs function and the importance of the AP's role in ensuring efficient market pricing and index tracking. Ignoring such divergences could lead to clients holding an ETF that is not performing as expected, potentially violating suitability requirements. Professionals should approach such situations by first understanding the operational underpinnings of the investment products they recommend. This includes a thorough knowledge of how ETFs are created and redeemed, and the role of authorized participants. When performance metrics deviate, the professional should investigate potential causes related to the creation/redemption process, market liquidity, and any specific operational issues before concluding on the ETF's overall suitability or performance. Question 13. The risk matrix shows that Fund X has an expense ratio of 1, 50%, and Fund Y has an expense ratio of 0, 75%. When discussing these funds with a client who is concerned about the overall costs of investing, which of the following approaches best addresses the client's concern and adheres to regulatory requirements? Option A. State that Fund X's higher expense ratio of 150% indicates it is likely a more actively managed or higher performing fund than Fund Y. Option B. Explain that the expense ratio represents the annual operating costs of the fund as a percentage of its average assets, meaning Fund X's costs are higher than Fund Y's, which directly impacts the investor's net return. Option C. Simply present the expense ratios of 1, 50% for Fund X and 0, 75% for Fund Y, allowing the client to interpret the numbers themselves. Option D. Inform the client that the expense ratio is a minor detail and not a significant factor when choosing between similar investment funds. The correct answer is B. Explain that the expense ratio represents the annual operating costs of the fund as a percentage of its average assets, meaning Fund X's costs are higher than Fund Y's, which directly impacts the investor's net return. Explanation. This scenario is professionally challenging because it requires a registered representative to interpret and communicate complex fund information to a client in a way that is both accurate and understandable, without misleading the client. The expense ratio, while a key metric, can be misunderstood if not properly contextualized. A representative must prioritize client understanding and suitability over simply presenting raw data. The correct approach involves explaining the expense ratio as a measure of the fund's operating costs relative to its assets, emphasizing that higher ratios generally mean higher costs for the investor. This approach is correct because it directly addresses the client's need to understand what they are paying for and how it impacts their investment returns. This aligns with FINRA Rule 2111, Suitability, which requires recommendations to be suitable for the customer based on their investment objectives, risk tolerance, and financial situation. Furthermore, it adheres to the general principles of fair dealing and ethical conduct expected of registered representatives. An incorrect approach that focuses solely on the numerical value of the expense ratio without explanation fails to meet the suitability standard. It provides data without context, potentially leading the client to make an uninformed decision. This could be seen as a violation of the duty to provide adequate information for a suitable recommendation. Another incorrect approach that highlights the expense ratio as a primary indicator of fund performance is misleading. While expenses can impact performance, they are not a direct measure of a fund's success or failure. This misrepresentation could violate FINRA rules regarding misleading statements and omissions. A third incorrect approach that dismisses the expense ratio as insignificant without proper justification is also problematic. While some clients may prioritize other factors, the expense ratio is a material fact that can affect an investor's net return. Ignoring or downplaying it without a valid reason could be considered a failure to disclose material information. Professionals should approach such situations by first understanding the client's knowledge level and then tailoring their explanation to ensure comprehension. The decision-making process should involve 1. Identifying the client's information needs, 2. Retrieving relevant data like the expense ratio, 3. Contextualizing the data in a clear and understandable manner, 4. Relating the data to the client's investment goals and suitability, and 5. Ensuring no misleading information is conveyed. Question 14. Process analysis reveals that a client expresses a strong desire for their investment portfolio to experience significant capital appreciation. However, during further discussion, it becomes apparent that the client also relies on their investments for a portion of their current living expenses. Which of the following approaches best aligns with the representative's ethical and regulatory obligations? Option A. Recommend a high dividend income fund to ensure the client has sufficient cash flow to cover living expenses. Option B. Recommend a speculative investment known for its high potential returns, highlighting the client's desire for rapid growth. Option C. Recommend a pure growth fund with a history of aggressive capital appreciation, emphasizing the client's stated desire for growth. Option D. Recommend a balanced fund that seeks both capital growth and income generation. After a thorough assessment of the client's overall financial situation, risk tolerance, and time horizon. The correct answer is D. Recommend a balanced fund that seeks both capital growth and income generation. After a thorough assessment of the client's overall financial situation, risk tolerance, and time horizon. Explanation. This scenario presents a professional challenge because it requires balancing a client's stated desire for growth with their underlying need for income, a common situation when discussing balanced funds. The representative must navigate potential conflicts between a client's perception of their needs and their actual financial situation and risk tolerance, all while adhering to regulatory obligations. The correct approach involves a thorough needs assessment that goes beyond the client's initial statement. This includes understanding their current income sources, expenses, investment objectives, time horizon, and risk tolerance. By recommending a balanced fund that offers both capital appreciation potential and regular income distributions, the representative aligns the product with the client's dual objectives. This approach is ethically sound and compliant with FINRA regulations, particularly the Suitability Rule, FINRA Rule 2111, which mandates that recommendations must be suitable for the customer based on their investment profile. The representative is acting in the client's best interest by providing a product that addresses both stated and implied needs. An incorrect approach would be to solely focus on the client's stated desire for growth without probing further into their income needs. This could lead to recommending a growth fund that prioritizes capital appreciation over income, potentially leaving the client without the necessary cash flow they implicitly require. This failure to conduct a comprehensive needs assessment violates the suitability rule and could be considered a breach of fiduciary duty if applicable, or at least a failure to act with diligence and care. Another incorrect approach would be to recommend a high-yield income fund without considering the client's desire for capital appreciation. While this might satisfy an income need, it could expose the client to higher risks and limit their potential for long-term growth, again failing to meet the client's stated objectives and potentially violating suitability standards. Finally, recommending a complex or speculative investment solely because it offers high potential returns, without adequately assessing the client's risk tolerance or income needs, would be a significant ethical and regulatory failure. This disregards the balanced nature of the client's implied needs and prioritizes potential high growth over suitability and risk management. The professional decision-making process should involve active listening, probing questions to uncover all relevant client information, and a systematic evaluation of investment products against the client's complete financial profile and objectives. The representative must always prioritize the client's best interests and ensure that any recommendation is suitable and compliant with all applicable regulations. Question 15. Governance review demonstrates that a significant portion of a mutual fund's 12b1 fees are being allocated to cover the costs of preparing and distributing sales literature that highlights the fund's performance over the past year. While this literature is intended to attract new investors, the review also notes that some of the performance data presented is from a period when the fund was managed by a different investment advisor. The fund's compliance officer is seeking your guidance on whether these expenditures are appropriate under the 12b1 plan. Option A. Advise that the expenditures should be carefully scrutinized to ensure they are solely for the distribution and marketing of fund shares, and that the presentation of performance data is fair and not misleading, considering the change in investment advisor. Option B. Recommend that the expenditures be approved, provided that the fund's board of directors has reviewed and approved the 12b1 plan, and the expenses are documented as distribution costs. Option C. suggests that since 12b1 fees are intended for marketing, any expense related to sales literature, regardless of content or historical context, should be permissible. Option D. Approve the expenditures, as the literature is designed to attract new investors and the performance data, even if from a prior management period, is factual. The correct answer is D. Approve the expenditures, as the literature is designed to attract new investors and the performance data, even if from a prior management period, is factual. Explanation. This scenario presents a professional challenge because it requires a representative to balance the interests of the investment company, its shareholders, and the regulatory requirements surrounding 12b1 fees. The core of the challenge lies in ensuring that marketing and distribution expenses funded by 12b1 fees are genuinely for the benefit of the fund and its shareholders, rather than being used to improperly incentivize sales or cover expenses that should be borne by the investment advisor. Misrepresenting the purpose or use of these fees can lead to violations of SEC regulations and erode investor trust. The correct approach involves a thorough and transparent review of the 12b1 fee expenditures. This means verifying that all costs charged against the 12b1 fund are directly related to the distribution and marketing of fund shares, such as advertising, prospectus printing for sales purposes, and sales commissions. The justification for these fees must be documented and demonstrate that they are in the best interest of the shareholders. This aligns with the SEC's oversight of 12b1 fees, which are intended to facilitate the sale and distribution of fund shares, thereby potentially increasing the fund's assets under management and benefiting all shareholders through economies of scale. Adhering to these principles ensures compliance with the Investment Company Act of 1940 and its rules governing 12b1 plans. An incorrect approach would be to approve the expenditures without adequate scrutiny, assuming they are legitimate simply because they are presented as marketing costs. This fails to uphold the representative's fiduciary duty to the fund and its shareholders. Another incorrect approach is to overlook the fact that 12b1 fees are not intended to cover general operating expenses of the investment advisor, such as office rent or salaries unrelated to distribution. Charging such expenses to the 12b1 fund would be a direct violation of the rules. Furthermore, ignoring potential conflicts of interest, such as using 12b1 fees to incentivize sales of specific funds over others without a clear benefit to the fund being sold, is also a regulatory and ethical failure. The professional decision-making process in such situations should involve a critical assessment of each expense item against the defined purpose of 12b1 fees. This requires understanding the specific provisions of the fund's 12b1 plan and relevant SEC rules. When in doubt, seeking clarification from legal counsel or compliance departments is essential. The ultimate goal is to ensure that shareholder money is used appropriately and in compliance with all applicable regulations, fostering transparency and investor confidence. Question 16. The evaluation methodology shows that a client is seeking an investment product that will provide a consistent stream of current income, and the representative is considering various income-oriented funds. When discussing a bond fund's income-generating capabilities, which of the following best reflects the appropriate focus for the representative? Option A. Recommending funds based solely on their historical dividend yield performance. Option B. Prioritizing funds with the lowest expense ratios as the best indicator of income generation. Option C. Explaining that bond funds generate income through interest payments from their underlying bond holdings and focusing on metrics like yield to maturity. Option D. Emphasizing the fund's stated dividend yield as the primary measure of income. The correct answer is D. Emphasizing the fund's stated dividend yield as the primary measure of income. Explanation. This scenario is professionally challenging because it requires a representative to balance the client's stated objective of current income with the inherent risks and complexities of bond investments, while adhering strictly to FINRA regulations and the Series 6 exam scope. The representative must avoid making recommendations based solely on superficial metrics like dividend yield, which can be misleading for bond funds, and instead focus on the underlying characteristics of the bonds held by the fund. The correct approach involves understanding that dividend yield is a term primarily associated with equity investments and is not the most accurate or comprehensive measure for income generated by bond funds. For bond funds, the relevant metric for current income is typically the fund's yield to maturity, or current yield, which better reflects the income an investor can expect from the bond holdings, considering their purchase price, coupon payments, and time to maturity. A representative must explain to the client that bond funds generate income through interest payments from the underlying bonds, not dividends. This approach aligns with the regulatory requirement to ensure that recommendations are suitable for the client's investment objectives, risk tolerance, and financial situation, and that the representative provides accurate and complete information about the investment products. An incorrect approach would be to focus solely on the stated dividend yield of a bond fund as the primary indicator of its income-generating potential. This is a regulatory failure because it misrepresents the nature of income from bond investments and fails to educate the client on the appropriate metrics. It can lead to a misunderstanding of the fund's true income characteristics and potential risks. Another incorrect approach would be to recommend a bond fund based solely on its historical yield without considering the current interest rate environment or the credit quality of the underlying bonds. This is an ethical and regulatory failure, as it neglects the duty of care to ensure the recommendation is suitable and based on a thorough analysis of the fund's current holdings and market conditions, potentially exposing the client to undue risk. Recommending a fund solely based on its expense ratio, while important for overall return, is also an incorrect approach when the primary objective is current income, as it doesn't directly address the income generation of the fund's underlying assets. Professionals should adopt a decision-making process that begins with a thorough understanding of the client's stated objectives and then translates those objectives into the appropriate investment product characteristics and metrics. This involves educating the client about the specific nature of the investment, using accurate terminology, and analyzing the investment's suitability based on its underlying assets and current market condition, all within the bounds of regulatory guidance. Question 17. Benchmark analysis indicates that the prevailing brokerage commission rates for secondary market trading of listed securities have stabilized. A registered representative is discussing the sale of a client's municipal bond holdings. Which of the following best reflects the regulatory expectation regarding brokerage commissions in this scenario? Option A. The representative should charge a commission that is reasonable and clearly disclosed to the client, reflecting the services provided and prevailing market rates. Option B. The representative should charge a commission based solely on the firm's internal profit targets for the quarter. Option C. The representative should not disclose the specific commission amount, but rather provide a total transaction cost to the client. Option D. The representative can charge a commission that is significantly higher than the benchmark analysis suggests, as long as the client verbally agrees to the fee. The correct answer is A. The representative should charge a commission that is reasonable and clearly disclosed to the client, reflecting the services provided and prevailing market rates. Explanation. This scenario is professionally challenging because it requires a representative to understand and apply the nuances of brokerage commissions in secondary market trading within the specific regulatory framework of the Series 6 exam. The challenge lies in distinguishing between legitimate commission structures and those that could be construed as excessive or indicative of a conflict of interest, all while adhering to FINRA rules. Careful judgment is required to ensure fair dealing with customers and to avoid practices that could lead to regulatory scrutiny. The correct approach involves accurately disclosing all brokerage commissions and ensuring they are reasonable and commensurate with the services provided. This aligns with FINRA Rule 2121, which prohibits excessive markups and markdowns, and by extension, requires fair and reasonable commissions. Transparency in commission structures is paramount, ensuring the customer understands the costs associated with their transactions. An incorrect approach would be to obscure the commission structure or to charge a commission that is disproportionately high compared to the services rendered or the prevailing market rates. This could violate FINRA general anti-fraud provisions and its rules regarding fair dealing with customers. Another incorrect approach would be to fail to disclose the commission structure clearly, leaving the customer unaware of the full cost of the transaction, which is a breach of disclosure requirements and erodes trust. Finally, structuring commissions in a way that creates an undue incentive for the representative to recommend certain products over others, without regard for the customer's best interest, would be ethically and regulatorily unsound, potentially violating FINRA suitability and best interest obligations. Professionals should approach these situations by prioritizing transparency and fairness. This involves understanding the specific commission schedule, comparing it to industry standards, and clearly communicating all fees to the client before the transaction. When in doubt, seeking guidance from a supervisor or compliance department is the most prudent course of action. Question 18. The efficiency study reveals that Fund X, which states its objective as capital appreciation through investment in large capitalization growth stocks, has been increasingly allocating a significant portion of its assets to small capitalization value stocks, a strategy not disclosed in its prospectus. A registered representative is considering recommending Fund X to a client seeking aggressive growth. Which approach best aligns with regulatory requirements and professional ethics? Option A. Recommend Fund X to the client, emphasizing its aggressive growth potential and the potential for higher returns associated with small-cap value stocks, as suggested by the study's findings on its current holdings. Option B. Recommend Fund X to the client, highlighting its stated objective of capital appreciation and its historical performance, while downplaying the study's findings on the shift in investment strategy as a minor deviation. Option C. Decline to recommend Fund X and instead identify alternative funds whose investment strategies are consistent with their stated objectives and the client's aggressive growth objective, based on the information provided by the study and the fund's prospectus. Option D. Recommend Fund X to the client, explaining that the study indicates a more diversified approach than initially stated, which could be beneficial for aggressive growth. The correct answer is A. Recommend Fund X to the client, emphasizing its aggressive growth potential and the potential for higher returns associated with small-cap value stocks, as suggested by the study's findings on its current holdings. Explanation. This scenario presents a professional challenge because a registered representative must accurately interpret and apply information from an efficiency study to advise a client on fund selection. The challenge lies in moving beyond superficial understanding to a deep comprehension of how investment strategies align with stated objectives and how to communicate this effectively and ethically to a client. Careful judgment is required to ensure the advice is not only technically correct, but also in the client's best interest, adhering to suitability standards. The correct approach involves recognizing that the efficiency study's findings on a fund's strategy directly impact its ability to meet its stated objectives. A representative must analyze whether the fund's actual investment activities, as highlighted by the study, are consistent with its prospectus and the client's financial goals, risk tolerance, and investment time horizon. This aligns with the fundamental regulatory requirement under the Securities Exchange Act of 1934 and FINRA rules to ensure that recommendations are suitable for the customer. Ethically, it demands a commitment to acting in the client's best interest by providing informed and accurate guidance based on comprehensive analysis. An incorrect approach would be to solely focus on the fund's past performance metrics mentioned in the study, ignoring the underlying strategy. This fails to address the core question of whether the fund is likely to continue meeting its objectives in the future, as performance can be cyclical and past results are not indicative of future outcomes. This approach risks violating suitability rules by recommending a fund based on incomplete information, potentially exposing the client to undue risk or failing to meet their investment needs. Another incorrect approach is to prioritize funds that appear to have lower expense ratios, as indicated by the study, without considering their strategic alignment with objectives. While cost is a factor, it should not supersede the primary goal of achieving the client's investment objectives. Recommending a low-cost fund that deviates significantly from its stated strategy or the client's needs is a breach of suitability and ethical duty. A third incorrect approach involves recommending a fund solely because the efficiency study highlights its diversification benefits, without assessing if that diversification is appropriate for the client's specific situation or if it aligns with the fund's stated objective. Diversification is a tool, not an end in itself, and its value is context-dependent. Recommending it without considering the client's overall portfolio and objectives is a failure to provide tailored advice. The professional decision-making process for similar situations should involve a systematic evaluation. First, understand the client's objectives, risk tolerance, and financial situation. Second, analyze the fund's prospectus, including its stated objectives and investment strategies. Third, critically review any external studies, like the efficiency study, to understand how the fund's actual operations and strategies align with its stated goals and the client's needs. Finally, make a recommendation that is demonstrably suitable, well supported by evidence, and clearly communicated to the client, prioritizing their best interests above all else. Question 19. Market research demonstrates that investors are increasingly concerned about the total cost of their investments. A client is considering investing in a mutual fund and asks for clarification on how account fees and redemption fees will impact their returns. Which of the following explanations best addresses the client's concern by accurately distinguishing these fee types and their implications? Option A. Account fees are charged by the brokerage firm for maintaining your investment account, while redemption fees are imposed by the mutual fund when you sell your shares within a specific time frame, both of which reduce your overall investment gains. Option B. Account fees and redemption fees are essentially the same, as both are charges deducted from your investment value over time. Option C. Redemption fees are the primary concern, as they are directly tied to selling your shares, and account fees are usually negligible. Option D. Account fees are a one-time charge when you open the account, and redemption fees are only applicable if you hold the investment for a very long period. Correct answer is A. Account fees are charged by the brokerage firm for maintaining your investment account, while redemption fees are imposed by the mutual fund when you sell your shares within a specific time frame, both of which reduce your overall investment gains. Explanation. This scenario is professionally challenging because it requires a registered representative to accurately explain complex fee structures to a client, ensuring the client understands the financial implications of their investment choices. The representative must navigate the nuances of account fees and redemption fees, which can significantly impact an investor's net returns, especially for those who trade frequently or redeem shares early. A failure to provide clear and accurate information can lead to client dissatisfaction, regulatory scrutiny, and potential financial harm to the investor. The correct approach involves clearly differentiating between account fees and redemption fees, explaining their purpose, and illustrating how each can affect the client's investment. Account fees are typically charged by the brokerage firm for maintaining the investment account, regardless of trading activity, and can include annual fees or inactivity fees. Redemption fees, on the other hand, are charged by the mutual fund itself when shares are sold within a specified period, often to discourage short-term trading and protect long-term shareholders from the costs associated with frequent redemptions. A representative must explain that account fees are a cost of holding the investment, while redemption fees are a cost of selling it, and that both reduce the overall return. This aligns with FINRA Rule 2111, suitability, which requires recommendations to be suitable for the customer, and the general ethical obligation to act in the client's best interest by providing transparent and understandable information about all costs associated with an investment. An incorrect approach that conflates account fees with redemption fees, suggesting they are the same type of charge or that one negates the other, is a significant regulatory and ethical failure. This misrepresentation violates the duty of fair dealing and can mislead the client about the true cost of their investment. Another incorrect approach that focuses solely on the redemption fee while ignoring the impact of account fees on the overall investment cost is also problematic. This selective disclosure fails to provide a complete picture of the expenses involved, potentially leading the client to underestimate the total cost of ownership. Furthermore, an approach that dismisses the importance of these fees altogether, implying they are minor or insignificant, demonstrates a lack of diligence and a failure to uphold the professional standard of care required when advising clients on investment products. This can be seen as a violation of the spirit, if not the letter, of regulations requiring full disclosure of material information. Professional decision-making in such situations requires a commitment to transparency and client education. Representatives should always prioritize clear communication, using plain language to explain complex financial terms. They should be prepared to answer client questions thoroughly and accurately, and to provide examples that illustrate the practical impact of fees. When in doubt, it is always better to err on the side of providing more information rather than less, ensuring the client can make informed decisions based on a complete understanding of all associated costs. Question 20. System analysis indicates that a registered representative is meeting with a new client who has expressed a strong desire for quick and substantial growth in their investment portfolio. The client is in their late 20s, has a stable income, and has indicated they have a high tolerance for risk. However, during the conversation, The client also mentioned a recent negative experience with a volatile stock that caused them significant stress. The representative is considering how to best structure the initial portfolio recommendations, balancing the client's stated desire for growth with their expressed concern about volatility. Which of the following approaches best aligns with regulatory requirements and ethical obligations? Option A. Recommend a portfolio composed entirely of conservative, low-yield government bonds to ensure maximum safety, as the client mentioned a negative experience with a volatile stock. Option B. Recommend a complex, high-commission variable annuity product with aggressive stock subaccounts, as this product can offer growth potential and the representative is familiar with its features. Option C. Recommend a portfolio heavily weighted towards aggressive growth stocks, emphasizing the client's stated desire for quick and substantial growth and their high risk tolerance, while downplaying the potential for volatility. Option D. Recommend a diversified portfolio with a significant allocation to growth-oriented equities, complemented by a smaller allocation to bonds, while thoroughly discussing the potential for both high returns and the inherent risks of market fluctuations, including the client's past experience. The correct answer is D. Recommend a diversified portfolio with a significant allocation to growth-oriented equities, complemented by a smaller allocation to bonds, while thoroughly discussing the potential for both high returns and the inherent risks of market fluctuations, including the client's past experience. Explanation. This scenario presents a professional challenge because it requires a registered representative to balance a client's stated risk tolerance with the representative's fiduciary duty and knowledge of suitable investments. The representative must avoid making recommendations based solely on personal gain or a superficial understanding of the client's needs, adhering strictly to FINRA regulations and ethical standards governing investment advice. The correct approach involves a thorough assessment of the client's financial situation, investment objectives, and risk tolerance, followed by a recommendation of a portfolio composition that aligns with these factors, even if it means deviating from the client's initial, potentially misinformed preference. This aligns with FINRA Rule 2111, Suitability, which mandates that a broker-dealer or associated person must have a reasonable basis to believe that a recommended investment or strategy is suitable for a particular customer based on their investment profile. The representative's duty is to act in the client's best interest, which may involve educating the client about the risks and potential rewards of different asset classes like bonds and stocks, recommending a portfolio heavily weighted towards aggressive growth stocks solely because the client expressed a desire for high returns, without a deeper understanding of their capacity for loss, would be an ethical and regulatory failure. This approach prioritizes the client's stated desire over their actual ability to withstand market volatility, violating the suitability rule, suggesting a portfolio composed entirely of low-yield, highly conservative bonds because the client mentioned safety, without exploring their long-term goals or potential for growth, would also be a failure. This approach might not meet the client's investment objectives, such as long-term wealth accumulation, and could be considered unsuitable if it fails to adequately address their needs. Pushing a complex, high-fee variable annuity product that offers aggressive stock subaccounts simply because it is a product the representative is familiar with and earns a higher commission on, without a clear demonstration of its suitability for the client's specific circumstances, is a significant ethical breach and a violation of FINRA rules regarding fair dealing and best execution. The professional decision-making process should involve 1. Actively listening to and understanding the client's stated goals and concerns. 2. Conducting a comprehensive fact-finding process to establish the client's complete investment profile: age, income, net worth, liquidity needs, tax status, investment experience, and risk tolerance. 3. Analyzing the client's profile to determine appropriate asset allocation strategies and investment vehicles. 4. Educating the client about the risks and potential rewards of recommended investments. 5. Making recommendations that are demonstrably suitable for the client's individual circumstances, prioritizing their best interests over the representatives or firms.